In today's lesson, we're going to talk about emotions and how they relate to your profits. At the end of this lesson, you should be able to answer the following questions. What are the odds of failing in trading? Where would you fit on the scale of fearful and greedy? Why should you protect your emotions during trading? Let's get into the lesson. First, we need to talk about odds, chances, probabilities. So anybody knows if you were to flip a coin, you would have a 50-50 chance of either selecting heads or tails. So trading should be the same, right? You should have a 50-50 chance. So why is it that 90% or more of traders lose their money? If you have a 50-50% chance, should you not break even? So why do most traders lose money instead of breaking even? The answer is emotional. It's psychological. It's all about them letting their losers run because they're afraid to lose, and taking profits too early because, again, they're afraid to lose. So it's all about the fear of losing. So here's an example of a typical trader. He may have 4 winning trades and 4 losing trades. However, the wins only account for $1,800, but the losses are far greater, thus bringing his net loss to $2,500, despite having an equal number of wins and losses. So what is this emotional reason behind all of this? The reason, at least in my opinion, is that there are 2 types of traders who make mistakes. There's the overconfident and then the insecure trader. So let's look at those individually. Either way, they come from different backgrounds, but in the end, they have the same catastrophic results. They operate on the extremes of fear and greed. So the overconfident trader, he begins his journey from greed. Just like any unsuccessful trader, he accumulates a lot of losses. And these losses, based on his personality, are going to lead to an internal disappointment that he simply refuses to accept. After all, he is very successful. He may be a successful businessman. He may have been very diligent about working hard his entire life and saving. He may have a PhD, he may be very socially accepted, or have some other achievements. So he carries with him, based on his past and everything he has done in his past and all the right choices he has made, he carries an internal overconfidence when it comes to trading. So these people who are usually successful in life have a really difficult time transitioning into trading, because the market is too big for them and they refuse to go with the market because they want to do things their own way. So this overconfident trader, having lost $2,500, now is into his own territory. He feels challenged by the market, when in fact the market just doesn't care. So he goes out there and he is extremely driven, he's relentless. The very same virtues elsewhere in life are becoming his vices. Trading is all about patience. So instead, he becomes driven, he gains momentum, and he expects success because he has another trade that he jumped into. Unfortunately, the cycle repeats itself, and it keeps repeating and repeating, and the overconfident trader, his virtues again being the refusal to give up and sometimes even stubbornness, he is able to accumulate the greatest loss of all the types of traders. These are the people who are most prone to the greatest losses. So what is a trader to do if he finds himself in this emotional state? Well, at the point of internal disappointment, what he needs to do is to realize, acknowledge this overconfidence that he is feeling, and instead of rushing into a trade, he needs to take himself aside, relax, maybe do something else, reassess, and then he can take his controlled losses when he cools down a little bit, and we will talk about controlled losses later. And when he cools down a little bit, comes back, does more research, improves the probabilities just based on the extra work he put before he enters the trade, he can now go back in, and instead of over trading trades that are not high probability trades, he's going to have a more solid trade, and he is going to gain internal confidence instead of internal overconfidence. And so he is shifting from greed to more of a middle ground, something more reasonable. And this is called the reliable trader. And so essentially what happens? These bad wins and losses, this P&L disappears, and he improves his profits. On the other side of the spectrum, we have the fear trader. So this is the one that we also call the insecure trader. They come again from different emotional stages, but the results are the same: catastrophic losses, in this case of $2,500. So this insecure trader also experiences internal disappointment, but he deals with it differently. Instead of feeling overconfidence, he feels internal insecurity. So he feels like it's a direct attack on himself as a person, but instead of being overconfident and expecting success, he is feeling nervous and anxious, and therefore he also has the impulse to trade. And so he jumps into any trade he can find because he has this urgency to act, because his emotions are compromised. And as a result, he continues this vicious cycle of losing and losing and losing. So again, what is this insecure trader to do? The same thing. Once you experience this internal disappointment, and by internal disappointment in both cases, I mean the onset of these extremes. So when at the first sign you notice that you are becoming overconfident or insecure, you need to take yourself aside, reassess, relax, maybe do something else, and then come back. But definitely take a controlled loss because you're not ready to trade. And then you can do your research and enter another trade that is a higher probability trade, a more solid trade, and as a result, this insecurity can become internal caution. And again, this trader who was fearful is now becoming more and more in the middle ground between fear and greed. And notice how he is not insecure anymore, but he still has caution. And that is actually the sign of a reliable trader. So a reliable trader is self-confident, but not overconfident. He is cautious, but definitely not insecure. So at times of caution, he knows to close his trade when things are not working his way, but at the same time, his confidence allows him to let the trades run in case they are winning and to execute his plan as needed. So let's talk about these extremes in trading. So let's talk about these traders who are fearful or greedy. And believe me, most of us are like this. Some may be more, others less. But every trader is always trying to find some sort of middle ground in trading. So let's talk about these extremes. The reliable trader, which is what you should become, is somebody who is consistently good in quality or performance, somebody who can be trusted. And so you need to be consistent. You have to make profitable trade on a repetitive basis, and as a result you're going to accumulate more and more profits. Your account is going to grow, and then at some point you're going to realize the power of compounding. And so your profits are going to compound, and you will become more and more powerful in terms of your trading. However, you have to pass a certain threshold in terms of knowledge, in terms of account size to get there. And that is what you need to keep in mind. You have to come up with a plan that can be repeated and that can work. So in other words, what you need are small steps over time, whereas the overconfident and the insecure trader have an all or none mentality. They're always cycling around the same area in their account size, never getting anywhere, never gaining anything, and they become more and more frustrated. Why? Because for every bit that they profit, they immediately lose it. So the overconfident trader is somebody who is excessive or unreasonable. An overconfident trader doesn't look at price action. He thinks that he deserves a sudden move in his direction. And so this might be a person who expects to gain $3 on a $10 stock within a day. Whereas the insecure trader is very similar. He also has an all or none mentality, but the problem with him is that he does not let his profits run. So here are two additional qualities. The overconfident trader lets his losers run because of overconfidence and exits winners too late when they turn negative. So most of the times with the overconfident trader, his profits are actually going to be positive, but he fails to take them. He fails to close the position. And then when the position turns negative on him, he then refuses to close it again because he feels entitled that it should go back to where it was. With the insecure trader, he lets his losers run because of fear and exits winners too soon, missing out on good profits. And see now how you can find a balance here. You have to find a balance between fear and greed. Why? Because you don't want to exit your winners too late, but you want to let them run enough so that you make the maximum profit. At the same time, you want to be emotionally healthy so that you know when to cut your losers instead of letting them run. So let's come up with an extreme example. After all, we are talking about extremes in trading. So here's a silly example. You can get from New York to Baltimore by car, but you can also build a rocket. Most people don't do this, but then again, most people don't trade and expect what these unrealistic traders expect. Sure, the rocket might get you there in minutes, but it may also crash or explode. The car might take longer. You may need to stop for gas, fix a flat tire. You may need to take sudden detours or battle afternoon traffic, but it will get you there, probably safely. So what's the problem with these two extreme traders? The problem with them is that they're trying to build a rocket. They don't want to take the car, they want to take a rocket somewhere. They have a goal, but they want to get there with a rocket. So the overconfident trader has this sense of entitlement. He does not want to be bothered by these petty details. And the self-conscious or the insecure trader is too afraid to even address them. And so they keep making the same mistakes over and over again because they are in denial. So how do we solve this problem? Let me give you a quote. One famous person once said, "I've missed more than 9,000 shots in my career. I've lost almost 300 games. 26 times I've been trusted to take the game-winning shot and missed. I've failed over and over and over again in my life, and that is why I succeed." This quote sounds very average. In fact, it sounds like somebody who didn't achieve very much said it. However, this quote actually was told by none other than Michael Jordan. But nobody remembers him as somebody who missed 9,000 shots. Nobody remembers him as somebody who lost 300 games. And again, he is considered a legend in terms of his sports. And the reason for that is because his winners, anything that he has done in terms of winning, has been stronger than anything he has done in terms of failure. And you have to be the same when it comes to trading. Do things that are going to make you win but expect that along the way you're going to also lose. So the question then is, how do you fail over and over again while making profits and keeping you emotionally healthy? Notice how I didn't say how do you win over and over again. No, the key is that you will fail. We as traders, we will always be failing, sometimes on a daily basis, but we have to make it work. So the question again, very important, how do you fail over and over again while making profits and keeping you emotionally healthy? You have two goals when you are trading. You're not only there to make profits, but you're also there to keep your sanity. You don't want to go from one extreme to the other. One day you win and you're extremely euphoric. The next day you lose and you're angry with everybody around you. You don't want that. You want to be emotionally healthy while also making profits. And the answer to this question is, you have to accept and refuse. You have to accept that you will make losing trades. No question about that. You will make losing trades. Accept that. But you also have to refuse something. What you have to refuse is, you cannot allow the losing trades to be larger than your winning trades. Most unsuccessful traders have it the other way around. They refuse to have losing trades, but they allow themselves to have losing trades to be bigger than their winning trades. And in order to determine how to answer this question, you have to define your profit zone. So from here forward, making a trading plan will be from my own experience. It will be my direct trading plan that I have shared with you. My trading plan will not be something that is abstract, as you have probably found to be in most books or most videos. My trading plan is specific, and the first part of my trading plan is to build an insurance policy. Just like an insurance policy has certain clauses and certain benefits and liabilities, here the first step in insuring myself is to define my profit zone. So what is a profit zone? A profit zone is an area between fear and greed. It's an area within which you would feel comfortable emotionally, and then the profits are going to happen on their own. You see, I don't operate from a money perspective. I don't first begin by saying I want to make XYZ today. The first thing that I do is to determine what my emotions are, and then where I fit in on that particular day of trading in terms of my emotions, and then I determine how much I will risk in the market. And so I define that as a profit zone. Trading is first and foremost, as I said, a balance of emotions. It's a balance of fear and greed. You must find where your emotional comfort zone is and then trade. The idea is that you will never find yourself in a trade where you will become too greedy or too fearful. The moment that you notice the onset of fear or greed, this is per my trading plan, I exit. Once I get into these extremes, it means that I'm not thinking objectively anymore, and therefore I am outside of my profit zone. My goal is to eliminate these extremes of greed and fear by defining how much I am willing to lose on any given trade. I also set realistic expectations by studying the past price action. We'll get into that later. And then also, as you notice, there is a second arrow on the fear side, and that arrow means that I have moved my profit zone as I have gained more experience. And again, as you get more into technical analysis, as you learn more about the details, it is very possible to move your profit zone and to maximize your profits. And this also coincides with your emotions becoming more and more stable, you becoming more confident and knowing better when to enter and exit. But we will talk about moving the profit zone later on. For now, we're just talking about defining the profit zone. And here is an example. So let's say that you have $100,000 for day trading that you can put up in one trade. So you might be trading a scalp or a quick day trade during the day. The first thing you need to do is to define what your maximum emotional loss would be for you. The maximum emotional loss actually has a dollar value. In this case, we will say it is $200. But a maximum emotional loss has to be something that you are emotionally attached to. If you say, I am willing to lose $200 on this trade, it doesn't mean very much. $200 doesn't mean much to human nature, but it means something when you can put a value on it. So in other words, if I can say that $200 pays for half a month of my car lease, then I have put a definition to it. So that's what you need to do. You have to put up with a maximum emotional loss and then define it in terms of something tangible that is in your life. So for example, you can use your mortgage payment, the salary at your current job. You can talk about your age and life goals, your retirement package, your family responsibilities. Do you have children? Do they need to be do they need money for their school? Do they need money for certain activities? What are your debt obligations? Do you have to make additional payments, as an example? So your maximum emotional loss is a reasonable amount of money. It's the maximum you are willing to lose on a trade, but it has to be a comfortable amount. If you get above that, you will be uncomfortable, and that's why you need to define it based on something tangible. So in other words, instead of saying I'm willing to lose $200 today, you need to start every trading day saying I am willing to lose, for example, a quarter of my month's mortgage payment today. If you lose more than that, then you need to stop trading and reassess. The next thing you need to do is to define three things: the price at which you will enter the trade, the price movement, in other words, how much does price fluctuate in that equity, and also the price target. Where do you think you will exit and take your profits? And for the price movement particularly, you need to know how volatile this equity is, but you can also look at the average true range. The next thing you need to do is to define, and this is very important, most traders don't do this, you need to define the expected length of time for the trade. So you have a price and a price target, but the next question you need to ask yourself is, based on the pattern, based on what I'm seeing on the charts, how long in terms of time will it take for this to play out? That is your anticipation in terms of timing. You also need to introduce a deadline. So at what point will you exit the trade? It doesn't matter if you still haven't hit your stop loss in terms of price. You also need to have a time stop loss, which is this deadline. So the question is, when do you exit the trade, irregardless of price? So you need to give your trade also a deadline. And to talk about this, let's put up an example. So your maximum emotional loss in this case is $200. The price at which you will enter is $50, so $50 per share. The target where you anticipate you will exit and make a profit is $50.22. The price fluctuates about 11 cents during that time period during which you plan to hold, which is 20 minutes. So you have given yourself a time of 20 minutes during which you anticipate that price will go up by 22 cents, after which you will take a profit. If price fluctuate, understand that if it fluctuates within 11 cents, that is about average and therefore not much of a concern. So in this case, this equity is not very volatile. However, if it fluctuated 50 cents, then understand that you are taking a greater risk, and we'll get into that on the next slide. And finally, what we also need is a time deadline, which is 35 minutes. So in other words, if the trade doesn't work out within 35 minutes, you exit, irregardless of price. And here is a formula you can use. Right now it may seem daunting, but once you plug in the different numbers, it makes a lot more sense. And this is what most good traders need to use anyway. Before you even enter a trade, you need to determine how much you are willing to risk. So in this case, as an example, we are going to determine how many shares we are willing to put up in this trade. So our maximum emotional loss was that $200 we're willing to pay. And remember, this maximum emotional loss has a tangible definition to it, such as a partial mortgage, for an example. Then you deduct your commission from there. And finally, the target price you anticipate minus the price at which you will enter. And that will be your number of shares that you will allow yourself to purchase. And in this case, if you plug in those numbers, you will learn that you will be comfortable buying 877 shares, and you are still within your profit zone. So again, this is all in terms of making everything tangible. Make sure to visualize this formula. Again, this formula seems daunting, but this is what every trader needs to use. And at some point it will become very repetitive and you will become used to it. And even so, what you need to do is you need to put it in plain English. So you need to come up with a sentence that you have to repeat to yourself over and over again during the trade, because those are your rules. So you would say something like, I will take my profits at the target of price X, and I will exit the position if price gets below Y. Now, exit, we will talk about that in another lesson. But the point of this lesson, again, this is my trading plan, but I am never willing to lose more than I am expecting to win. So notice how here we are expecting to go from $50 to $50.22. So I am anticipating a 22-cent gain. But at the same time, on the downside, I am not willing to take more than a 22-cent loss. Now granted, usually my stops are tighter, so it's not a 22-cent loss. It's usually smaller than that, and that is how I get my bigger reward, but that is for another lesson. There are also some adjustments you can make to your position size, and that is the beauty of having this formula, because you can use it to adjust your position size. And the formula is a great way to objectively quantify your emotions. So here's an example. If that particular equity has a higher volatility, so if, for example, the last equity we looked at fluctuated 50-60 cents instead of 11, then we would have to say that it has higher volatility. And there are certain areas of the markets that are more volatile. For example, commodities tend to overshoot certain levels, so you have to be careful with them. But either way, before you enter a trade, you have to study the price movement and understand overall what the volatility is. If there is a higher volatility in the equity that you are about to purchase, you have to have a smaller share size. Why? Because you have to allow it a greater stop loss, because there is all this fluctuation. But notice how a greater stop loss doesn't necessarily mean an overall bigger risk, because you're also decreasing the share size. So in other words, what you are doing is you are decreasing the share size at the expense of allowing your stop loss to run a little bit more. Technical factors and emotional factors also can be used to adjust your position size. So as an example, technical factors. For me personally, I like to have at least 3 different technical factors, and we will get into that later on. But these are things such as patterns, moving averages, indicators, and so forth. I like to have at minimum 3. If there are more than 3, then I feel more confident in taking on a full position. However, if I only have 2 or 3, then I might be taking a smaller position size, or if I don't like the way that price is moving or I cannot find anything on the chart, then of course I wouldn't trade it at all. Emotional factors, and here is the beauty of it, how you can use your maximum emotional loss. Emotions are difficult to quantify, but you know yourself best. And so what I do is, every morning, I assess my emotions, and I always have a scale in terms of 0 to 10 of how I am doing emotionally. And so what you can do is adjust this maximum emotional loss. For example, if last night I didn't get enough sleep, if I felt sick, if there is something that worries me, then my maximum emotional loss in the previous example may not be $200, but it may be $150. So again, keep track of your emotions before you begin trading and adjust for this maximum emotional loss in order to also adjust for your risk. And then also, when your deadline is exceeded, remember we talked about not just price, but you also have to put in a stop in terms of time. So once you are in a position and the closer you get to a deadline, what you can do is you can begin to scale out as you notice that your price is not moving as you want it to move, and then eventually once your deadline hits, you can exit completely. And the reason for this time deadline is very important. And again, as I mentioned, most people, they don't have a time stop loss. They only have a price stop loss. So price and time are not just factors to enter a trade. In later lessons, you will notice, especially with Fibonacci and other things, that price and time go together. Time is a hidden dimension in trading that most people don't look at. But that is one of the key factors that you have when entering a trade. So price and time in trading go together, and they will help you enter a trade. But we also have to understand that price and time are also factors to exit a trade. So remember that sentence that I told you, that you have to put that formula in a sentence? Here's another thing we need to add to that sentence. We also need to add a time stop loss. So for this example, we could say something like, I will exit position if price gets below $24.75, or if target price is not met within 35 minutes, whichever one happens first. And the reason for this, again, patterns tend to be distorted if too much time passes by. If you are, for example, buying a pullback on an uptrend, more than likely that pullback is on a consolidation pattern. And if that consolidation pattern takes too long, that just means that this particular stock is not ready to give you a final push, and therefore more and more buyers are accumulating, and then more and more of them are stuck in that position. So you would be wise to get out of it in time before price fails to the downside. If you're also playing a sudden reversal, you want to have an increase in volume. So a reversal has to be sudden. It has to be happening within that time period. If you are anticipating a sudden reversal and it doesn't happen in 35 minutes, then more than likely price is going to break down further. So as a review, what we need to make sure to know how to identify where you are on the fear to greed scale at any time during your trading. You also have to define the profit zone and the maximum loss you are willing to accept on any trade. You also have to know your position size before you enter a trade, and you also have to define the target price, target time frame, stop losses, and then also your stop loss deadline for each trade. Make sure to look at this and to define your own profit zones. And in the next video, we're going to go into more detail in terms of entry, in terms of exit, and how to make the odds go in our favor, and as well as journaling.